Good afternoon, everybody. I think it's a previous session to the lunch, so I think I need to make people alert. I'm not good at doing that, but let me try. Firstly, let me introduce myself. I'm an ex-banker. I used to work with different banks. I've worked with both the Indian banks as well as multinational banks. I was last with Standard Chartered Bank. I spent a lot of years in banking, about more than 20-25 years. After that, I was also in the IT company, Emphasis and Wipro, where I had worked for about, say, 3 years, around three and a half, 4 years, as a banking domain expert. So my experience has been more into banking and financial services. So I kind of, how I got into this and how I got interested into this is, firstly, I had a chance of, since having been working in banks, and I'm a student of personal finance. Not exactly when I started doing CFP, but actually as a person, I am generally interested in this particular field. So I kind of, having been into retail banking, consumer banking, so I got a chance to see what's happening around. And when I saw that, I noticed that, there is a clear lack of customer-centric approach in the banking, services, that whether it's, it's personal banking, wealth management, etc. It is kind of revolving around a set of products, a set of offering, and more tuned towards profitability of the entity that is there. So because there's no escaping from it. So I felt there is a need, and I also noticed that in my own experience I hardly came across anybody, one who approached me about this kind of concept of personal finance, personal financial planning, etc. Whatever I learned about it, I learned only from I learned from journals or whatever. That time, even before CFP came, so I just was curious about it. So I felt there is a big need. On the one hand, there is a need, and then there is a vacuum where the offering is not there. So I wanted to do something about it, and the thought was there. And so it took me a lot of time to get started, because around 2007, 2008, around that time, I enrolled for this CFP, with the FPSP, Financial Planning Standards Board, and but I couldn't do that. Also because that is when this financial crisis was there. I was a little skeptical of doing this and getting into a profession of this sort. So I went back to this profession, and I was with as I said, I worked with some companies. So only later on, I quit the job I was doing in the Emphasis, it's an IT company. But then I realized, this is not what I wanted to do, because I was I was doing solutions and solutions for international clients and all. I got bored with that. So I said I wanted to do something which is more to do with helping a person on a personal basis, one-to-one, how I can help the person. So that is when I wanted to do this, and that is when I came across Keyur. And what I found was, I've been wanting to do this, and later on I have approached a few people. I tried getting some notes, etc., of doing this course. I really found Keyur very different. In the sense, when I approached him, he said, and we did it I did this course through a video learning course. And most of it was actually some of these documents which are scanned and sent to me, and then these actual classes, live. So what I found about Keyur was a very clear approach to a practical sense of teaching. Actually, he sent me some documents which were scanned, which was handwritten. So I felt there's a lot of rigor which has gone into it. And as Dr. Ravindran mentioned, I was very taken in by that, the timeline which he used to draw. And that is something which I never saw anybody going to that level of detail. So I kind of related to it and it helped me a lot. Even today, I try to relate to that. And the very interesting thing was I was having this financial calculator with me. Okay, even before I met, I came in touch with Keyur. And I was using it somewhat. But Keyur actually taught me of certain tricks in the financial calculator, which I really, thank him even today. I try to use that. So those are some minor things. Actually, it is very important, and he is always available, and it helped me to pass this exam. He is doing a great job, I should say, and I think everybody should give him a round of applause. So but for him, I would have not done that, because I was having a limited time, and so he kind of helped me get into the grassroots level of learning the CFP, and say very detailed and very simple ways in which I learn these things. And it's very important to have a coach. Just like for in anything, like you need if you want to learn yoga, you need a coach. So that way you need a good coach. So that way Keyur is the person who came into mind, and I could benefit from it. I just have 3 slides, and I would cover then I would go to the next section, which is I wanted to do this practice. So what I actually felt at that time when I started doing the practice, I started doing the practice only about a year back. I felt that it's once you have a CFP, and considering that you have this experience and all, so I was under the impression that customers will come walking into me. So I said, okay, it's very easy, so I'll just start this and then customer. So then I waited. I said nothing is happening. So you call up a few people. Financial planning is last in the list of priorities. So that's when I realized, it's not just that you need to, you can actually make people come to you, but you have to go and approach people and tell them what it is. So that is very important. I wanted to tell this to this audience because some people may have a wrong conception that, it's like very easy to acquire clients and see what's the value of financial planning. Take it from me, financial planning, the concept as such, or whatever you do, the value addition, etc., has to be articulated with the client or the potential client. He will not, it's not magic that, somebody will just believe what you're saying and take to it. So before all that, if you're wanting to do a practice, some of you may be wanting to do a CFP as a job or, practice. So like me, if you want to do a practice, it's very important that you should have a strategy in your mind. That is just like any other business. CFP is again, if you want it to yield some income for you, you need to know how much you need to spend for your, for your office setup or your software, how much you're going to spend on knowledge part of it, etc. It's just like any other business. I mean, though we call ourselves like we are a financial doctor, whatever you call by, even a doctor has to run his business. It's not business. But actually speaking, he has to make money to sustain himself. So it's coming to that level. So when you want to do that, so you need to think through what's your target customer, how you're going to approach the customers, potential customers, how much of cost you're going to incur, etc., etc. You need to think through all this. It's not just magic, and it doesn't happen like that. Another is knowledge gap. So once you finish your CFP, CFP doesn't teach you about various products, whether it's mutual fund, whether it's any fixed income product, or anything else. Even even a simple what you call government schemes or whatever, and your tax. So when you approach a client or client approaches you, you are expected to know certain things, certain basic things about products. You're expected to know and answer it off the cuff. It's not that you can tell a client, I'll refer to something, I'll see which document it is, and then it won't go well with any potential client. So it's very important, the knowledge gap, as long as you're able to fill the knowledge gap, have it in have it with you ready. See, may be tax, it could be anything. Client may have number of queries, so you should be ready with those answers. And one very important thing I observed is that, see, we call ourselves financial planners, investment advisors. We call by, we talk within ourselves, and we have we have formed an opinion that we are so and so, and then the public views us as that. Actually speaking, when you go down to to any person in a common man, there is very little understanding about this profession. A lot of people, because see, they hear these terms, financial planning, they hear investment advice, investment advisor. This gets, somebody wants to sell insurance. Okay, that person calls himself as an investment advisor, and somebody says, yeah, I will do financial planning free. So all these things, confuses the general public. So if you want to actually stand out in this, so how do you do that? The only way you can stand out is you have to articulate to the client, the potential client or whoever, your value addition to the whole, his life. How are you going to add value? You can start off by saying that, what's your, if you have, he could start off with a problem that he has. A client may have a problem. He may have a problem with his, maybe he has too much loans. I incidentally came across one client of mine. I was very surprised. This is an IT professional. He was about 35 years or around that. And when I talked to him, he and his wife, both are well-earning people. They have already closed. They have one house. They have closed that house, and that house they have given it on rent. And they have got another house. They have taken a huge housing loan. Okay, maybe about 1 crore plus. And believe me, when I met him, he was having a problem with his monthly cash flows. So he was having problem paying off the loan. So, actually speaking, when you go and meet people, you have different experiences. So you can have a person, it's not just that somebody earns a lot and is quite, sufficient. He has got every set of, he has his cash flow enough to meet all his goals. So when you start talking about goals, so we need to think about all this. I'm also a SEBI registered investment advisor. I enrolled for that. And so that also requires a lot of rigor into the whole thing. One very important thing is when we do an asset allocation, normally when we do an asset allocation, we take the client risk tolerance and then do an asset allocation. So actually I got something I learned because of SEBI, because of this regulation. I learned that there are two parts to the risk assessment. One is a risk capacity, another is a risk tolerance. So risk capacity is something like, this friend of mine who I met, if he cannot repay the money and he is in real problem, and if you are recommending, because of his asset allocation, like Keyur was mentioning, you just can't go by a particular profile of a person or do that asset allocation, or maybe he might have ticked off. So when you give a risk questionnaire, normally we do a risk questionnaire, and then the question may come like he may be willing to take the risk. He might come across as an aggressive customer, by which you may be offering, if you offer or if you suggest or recommend 70% equity or something like that, and if he is having a problem with a day-to-day cash management, or he is not able to liquidate the loan, then have you done the right thing? So that's where as per the regulation, you have to do a risk capacity and a risk assessment. So though it looks very similar, I learned that this is entirely different. The risk capacity is an individual, for example, may have a lot of assets with him, and he may still be conservative in his approach of for meeting his goals. There you may probably recommend that you can take a little more risk, because he's got a lot of assets, his net worth is very good, but he is afraid to take the a little bit of risk. to achieve all those goals. So that is where I think financial planning or financial planner can be as a coach, like how Keyur is a coach for financial planners training. We are a coach for the customer. So that is how the whole thing has to evolve. And there are a lot of, it's our duty to, when I say busting the myths, it's basically they have a lot of people have created a lot of, like, this new fund offering is going to give you a much more better, returns. It could be anything. See, a lot of wrong information has been fed to the client many occasions. And another very important thing is there is a misconception, particularly in India, that real estate, if you invest, your job is done. I have come across people, one person I came across, when I started talking to him about retirement planning, he said, my retirement planning is done. Actually, he was right to some extent. He said, I have already one house, I have another two houses which I am planning, and I am thinking that house, the rental on that house is going to be my retirement planning. So, the perception, but when you say asset allocation, we say diversify with different asset classes, which means somewhere we need to kind of moderate this expectation from the client. So these are some things where we can play a role. I think as financial planners, we should tell people if they're 80% on real estate, if you kind of encourage and say, yeah, that's the best thing, then I think you've lost the game. I think somewhere we need to kind of convince, but for that to convince the client, we should have a very good conviction with ourselves that even though real estate has been a good asset class, because real estate has got very good returns in India over the past so many years. So many people are fully bought on to real estate. So that means you have a lot more convincing to do. So those are some things where you can actually add a lot of value to the client. And when you say asset allocation, if you stick to asset allocation, there again, if I think somewhere we were talking in the earlier sessions about tactical asset allocation. Okay, I feel that's very, very important. Recently, you've heard of Uday Kotak, the CEO of Kotak Mahindra Bank. So somebody asked him on one of the TV channels, so what do you think, the markets are, is it the right time to invest in the market? This must be, I think, now it's likely the markets are not doing that well now, but when it was really doing well a few months back. So he smiled and said, he said when the markets were at 25,000 and the PE ratio was, I don't know, somewhere 22 or something like that. So even then, he said, I've never heard any fund manager or any industry expert on the financial investment expert saying that, it's very, it's not a right time to buy. Everybody said at all times, people say this is the right time to buy. So here, the whole point is, as financial planners, it's our duty that it may be, the asset allocation need not be the same. If a person, let's say on an average, if a person has say 60% on equity and 40% on debt. So, but if the markets have gone so high that we know that it's going to moderate, because see, we heard a lot of things, which is correct. On the longer term, equities make money. The equity market is that on the longer term they make money, but at the same time it has its volatile phases. So it's very important that if the markets have gone very high, a person with a 60% equity, we may have to moderate and we may have to say, like, this time we will do a tactical asset allocation, and that doesn't really mean we do it for all the clients. If the client is putting sufficient money there, if it's for just a 2000 SIP, so you're not going to do tactical asset allocation, you will be just wasting time there. Because all your purchase and sale, again you have that redemption charges and all that. So I'm just giving a broad picture, this is my understanding. So these are some areas where we can actually show to the client that we add value. See, if we have to stand out, and if you're just saying that, if you're just giving some very good funds, you can say, Franklin Templeton, whatever, Prima plus is very good fund, you can take it. That anybody can tell. So what's the difference that you're having, adding to the client? So the only way that you can add value to the client is going a little deeper. So one more thing is on the financial planning itself. When you do financial planning with the client, what I try to do is I try to have a deeper conversation with the client. Mostly what happens is the client don't come out with the facts. You have to constantly talk to the client and find out whether first of all they give the data. The expense data is mostly understated, according to me. Most of them think that they don't really think through their expenses for the next few years. So that is again, you can add value. For example, everybody now buys almost every second year people buy a phone, maybe even 6 months. You can't say a cell phone. So has it gone into the cost? You can ask simple questions like that. It's not that we are going to ask something major. Again, obviously, you need to align with the goal and things like that. Again, when we talk about equity, etc., and when we have goals which are short term, whether we are aligning the goal which are short term with, are we giving a very risky product for a goal which is short term? So those are some things which it's in our control to suggest to the client. And because it's going to go wrong anyway. If a client has got, let's say, 3 years, he has some big commitment of say 8 lakhs, and you're suggesting an equity fund. Majorly, like let's say your asset allocation, you can't standardize your asset allocation. So if you're suggesting to a client a huge amount of equity for a 3-year goal, so you're obviously going to go wrong. You may succeed, but the chances are very low. So we have to take into account all this, and that's how we can show the value. So these are some thoughts which comes to my mind. I thought we can all do it. Do it yourself and robo advisors. This is another challenge which is there in current situations, because people are doing a financial plan for 2,000, 3,000 bucks, 3,000 rupees. So how can if you have to do a proper plan, it requires a lot of time. It requires considerable amount of analysis, and if you want to do that, you cannot do it in 2,000, 3,000 rupees, and that's what some of the online platforms are offering. So if you have to counter that, if you have to counter the robo advisors, you need to show the client your value. Another thing is you need to show your process. You have to say that we are very process oriented, and how we are actually different from anybody else who can offer something off the cuff. So lastly, I would like to say a few things. Like I said, this is something which I already talked about. How you can gain the client's trust. So basically, you can also help him in goal setting. Client may have some wrong ideas about certain goals, so you need to kind of articulate these things and show a long-term perspective to the client. When I say long-term, what I mean is you can there will be certain short-term goals as well as long-term goal, but the client has to start thinking long-term, because everybody now when you go to a TV channel, when you go anywhere, for example, I think he's not there now. I can ask someone. I read it somewhere recently that in any mutual fund, the average holding period in any mutual fund for investors is, I think it's about
2.8 years.
2.8 years or something like that. Whereas, if that is the case, most of the investors, actually it is improved. Earlier it used to be less than that, I heard. So if that is the case, then, obviously people are not holding on to it. So then how do we expect the fund manager also? The fund manager has to manage the money that we are giving. So it's a little complex. It's not as simple as, telling somebody it's a long term and he's going to see the volatility. But the only thing is, as people were mentioning about behavior, so we need to kind of coach the client and tell them that these periods of volatility will be there, but you have to see it through and say, you be with us, I'll be with you, and then you stick through this, and then we'll see the whole thing through. So that is how the whole approach has to be. And another way to convey to clients is something like you can compare it with even real estate. In real estate, it's not that somebody buys a real estate and sells it tomorrow. So I think that coaching has to be from the financial planner. And Another very important thing which I observed, and some of my colleagues I have heard that are very successful, is that clients look for, they want you to be a problem solver for them. So if you say I'll only do equity mutual fund and give you the offering, so they may not be satisfied with it. You may not actually do the tax filing for them, or you may not do something. If somebody wants to invest in some government scheme, you may not be the person who may be the distribution outlet for them, but at least you should be able to guide the person. If he wants a CA, you should be able to guide them to the right CA. Or if he is doing something international, at least you should be able to guide it. To that extent, I think we have a responsibility to the client. And the next topic, all you have to do is, if you Google fiduciary in just Google, you know what I'm talking about. Okay, in US, among investing public as well as the investment advisors, the most debated and the most hottest topic is fiduciary. Because see, what is happening in India is just a start. The challenges that we are facing now, that SEBI rules are bringing in the fiduciary responsibility. But it is not unique to only India. Everywhere the problems are the same. Because people realize that what is the meaning of fiduciary? Let me put it in very simple time. Anybody knows?
I'm going to invest your money, I have to explain my own money.
Yeah, it is simply speaking that I have the client's interest in mind before my interest. So if the client's interest is not in tune with what I am recommending, then it's just that it is not in. So actually speaking, it has to conform with the regulations of what the fiduciary rules are, and even for SEBI, those same rules are there. So ultimately speaking, it doesn't mean that one has to be an RIA or one has to be this. If you have the client's interest in front of you, and if you want to help the client in that way, automatically I think you become a fiduciary, and slowly you can migrate onto that. And then lastly, I want to even come to the question of, and a lot of discussion went around in today's discussion on the fees. How do we justify the fees? So all this, one thing is very clear. If we have to justify the fees, if you are a fiduciary, if you are an RIA, if you want to say that you can charge a financial planning fee, but again for investment, if you are demanding a fee, how do you do it? The only way that you can do it is you can show to the client that this is how I am adding value. And how do you add value? You have to tell the client, this is your investment and I have a responsibility. And you can say that the fiduciary responsibility makes me, you the central point of our relationship. If you tell that to the client is going to come around that way. And according to me, this is my personal opinion, I don't think, if you go to an average, if you look at an average person who is in the middle management, senior management level, or even people spend a lot of money on different things. It's not that people don't have money. I have come in Facebook, I have come across people who spend, for the new year, people spend a lot of money just for the one night. Okay, see, what is the hesitancy to ask a fee when people are spending money on different things? Like an international holiday costs not less than 2 lakhs of rupees, and people go almost, everybody, almost every second person goes. So it's not that people don't have money. If you go to the best restaurants in town, you will not get a seat. Am I right?
Yes.
I think, everywhere you go and people are ready to spend. See, and we think it is only in our mind that we are not asking the fees and we feel hesitant. It's our own misconception that people will not pay the fee. Actually, people have the money, but they have to see the value. So that is where I want to end it. So just at how you articulate the value. And more important is the best option. I have given different options, but what really can make a difference is if you can make a difference to the client's lives in whichever way, total overall way, you can guide him. See, there are sometimes you may have an opportunity. The client may be struggling with something which is not related to financial planning. You can still offer your help on that. Who stops you from doing that? I think that is a way you gain the client's trust. And if you gain the client's trust, fees is only, it's a question of, it's only a question of time the client will pay. That's all I wanted to say. Any question? Thanks.
Any quick question, one or two?
Sir, I have one question on this RIA
Yeah.
from SEBI.
Yeah.
So, could you just throw some light on what positives or negatives you look forward in terms of this?
The positives are, you are forced to conform with the regulation. You, as I said, you have a particular process to it. So you cannot escape it. You have to have the client's data in mind. You have to do the KYC. You have to do the, risk capacity. You have to do the, and you have to justify your investments with some logic. I cannot, offer something which is out of logic for the client. So that becomes mandatory. So that way, it's a positive. Negative, if you say, some people say it's a lot of work on the paperwork and all that. I don't agree with it. If you have a process in place, then it's only a question of it doesn't take much time, according to me. But the more bigger negative is if there are corporate RIAs and there are people like me who are individual RIAs. If you're a corporate RIA, you can also do distribution. Then people gain on both sides. Though you have an arm's length relationship, you try to get. I'm not saying that it doesn't exist, but it's like it's kind of a it's a positive thing there for them. But again that can be overcome if you are able to get an automated system on place, and you can offer it. The other way around is to offer a direct fund to the client, and then offer charge him a higher fee, which will be difficult. But once you show the value, again you have to articulate it. It's not easy. You have to tell the client, if I offer you a direct fund, so you're gaining so much out of it. So you're losing it, but you have to tell it's a client's gain. So once you say the client's gain, then he is willing to pay you some. If not 1%, at least he'll pay you 0.75%. I'm sure. That's all.
Yeah, one question again on the RIA. So, when the RIA regulation came, I was in touch with the Hyderabad SEBI office and all. So one of the interpretations, they refused to answer, but one of the interpretations which has come into the market is that if you are doing a financial plan, you have to be an RIA.
Yes.
Right? So that interpretation is right?
Correct. No. See, in a financial plan, it depends on, according to me, okay, again, it's my interpretation, but there's no, it's been clarified in some places.
Multi-product financial plan.
So as long as you give advice across product. So a financial plan will also involve insurance recommendations. It may not be the product itself, but again, you're going across. You're giving him an overall advice. So I think a financial planner, by giving a financial plan, he's automatically, he comes under the regulation and he has to be compliant, according to me.
So once you do a CFP, you don't really need to be an RIA?
No, that's a separate. RIA is by SEBI. You
Now
have to
let's conclude the presentation. First, we'll give to sir. With questions.
The problem comes in when any individual investor complains the SEBI.
So I'll take that and we'll wind up and we'll have a 45-minute break for lunch. So, yeah, thank you very much, sir. So basically, registered investment advisor is a regulation. Basically, it says that you are a distributor and you have to be a different, and there are two entities required. One is the financial advisor, or you can say investment advisor, or second is about the distributor. So in individual category, problem is that they have two name is required. Suppose husband is RIA, then wife may be a distributor. If wife is a RIA, then husband is a distributor. Okay. But in corporate, as sir rightly said that example, one corporate by paying just fee, they can have a both license, distribution as well as RIA. But please understand the objective here is to just to differentiate the your investment advisory practice and your distribution practice. If you are following in spirit, okay, automatically you are going to comply, and then you have to later on, once you have a sizable practice, you can register with the SEBI and ensure that you are complying fully. So that's how I don't find it is a more than because even examination they have set investment advisor level 1, level 2. It is a very basic level. So their objective is to create one kind of one more license. Okay, so that created license, and then over a period of time, once you grow the practice, you can comply with the requirement. So that's you can discuss one-to-one. Sir has already enrolled with the RIA. I think Ravindran sir has also enrolled with the RIA. So now thank you very much for participating in morning session, and definitely we are delayed. We are running short of time, so we'll take a 45-minute break, and by 2:45 we'll come back for the session. Your lunch is on 3rd floor. आपका lunch कहाँ पे है? 3rd floor पे है.